Hello, my name is Eddie Topic. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of Chicago wheat, Chicago corn, and Kansas City wheat. Chicago wheat. The recent market peaks at the January 2022 low at 739, turning low and creating a small descending triangle on the way down. The primary and secondary targets below for this pattern were both easily reached, and prices did not really stop until the dark blue highlighted neckline of the February to April reverse head and shoulders pattern, currently at 573. Please remember this neckline and its current level, as it will show up again later. I spoke on this 8 weeks ago when I said, and I quote, "This is what we are testing right now. Should this give way, then the next support is the December 2020 low at 566. And I suspect we might just see a slowing down towards there as the congestion throughout mid-February to late April starts kicking in under 588 and goes on all the way down to at least 545. So watch out for potentially some slowing from now onwards. This would also tie in with the idea of us looking at that small descending triangle as a possible halfway hesitation on the way down." End of quote. We have since then seen this slowing down. Not yet a complete stop, but a very strong slowing down. The congestion from mid-February to late April has indeed impacted on the market's decline. We've formed a small bear channel since late June, highlighted in bright red on my daily chart, and it's currently 533 up to 563. Last week I added on this point, and I quote, "I should say right now that I am willing right now to finesse the upper bear channel line and even move it into another pattern type if I see it." End of quote. Well, this week I will finesse it into a descending wedge pattern. Additionally, I believe that one should not look at this descending wedge pattern in isolation. Instead, look at it as part of the V-top, becoming a V-top with an extension formed since late June. So what can we tell from such a pattern? Well, usually such V-top patterns for extensions are small, much like the size of the earlier small descending triangle, usually pennants or bear flags. Not so in this case, but it does not take away from the case for such a larger pattern. Thus I would look for the descending wedge pattern trend lines to show some of the immediate support and resistance, which we have seen throughout July and also as recently as yesterday. The pressure in such a pattern will tend to be for lower prices, and I can see immediately that below we have the September 2020 low at 540. And more importantly, the 38.2% absolute Fibonacci line at 521. Personally, I would even start considering the 2016 to date uptrend currently at 479, and even the 2005 to date uptrend currently at 451. But these are not targets, not yet, just thoughts for another day. Finally, I draw your attention to, well, the dead cross on my daily chart. The green short medium moving average currently at 585 down through the gold long moving average currently 599. This is a lagging indicator, but still an indicator, and may fare better than when the short medium moving average pushed down below the mauve medium moving average, which is currently at 600, when it did not form a dead cross. Chicago corn. The extension to the lower trend line, currently at 466, of the July 2023 to January this year descending triangle, as well as the long moving average, currently at 450, capped the market throughout May, leading to a small double top pattern. Prices then headed lower, reaching both the primary and secondary targets for this double top, and then went below all the moving averages in mid-June, accelerating the fall once past the hurdle of November 2020 high at 439. Prices finally halted between the November 2020 low at 403 and the October 2020 low at 387, creating a teeny triple bottom and recovering all the way up to the high 3 weeks ago of the 50% absolute Fibonacci line at 425. In the process of pulling back up, the market made a small July-based ascending wedge pattern. Late 3 weeks ago, prices penetrated the lower trend line and soon after exited the pattern. The market easily reached the primary target at 404.5, but it took until this past Monday to drop down and reach the secondary target, harder to reach target X at 391. 3 weeks ago, I put forward a pattern idea, and I quote, "Considering the longer term, and only if the market really starts moving lower, consider whether this action throughout July is a bearish halfway hesitation or not." End of quote. Since then, I have come to reappraise this idea, and I will still leave this idea of a large bearish halfway hesitation out there with you, but I will also add another thought, and that is to look at the mid-June to date action as a possible descending triangle. There are arguments against this idea, but I find it elegant at the moment, and perhaps more importantly, we seemingly run out of time and space at the end of next week for this pattern, so I'll be able to give perhaps a better appraisal in my next commentary. Kansas City wheat. Okay, so late last year we saw the development of a descending triangle from late November 2023 to mid-February 2024, highlighted in purple still on my daily chart. 15 weeks ago we had an attempted breakout below, but prices hesitated and then continued to hesitate, such that what I initially thought might be a triple or a quad bottom eventually became a quintuple bottom and also a rectangle based on the 551 to 590 area. Now please remember this area, especially the lower level, as it will become relevant again in more recent action. On the 22nd of April, yes, I can narrow it down to a single day. On the 22nd of April, we saw the first significant breakout of this rectangle pattern on the upside, piercing, and then the next day closing over the medium moving average, currently 616, which had at the time run in parallel and just above the purple highlighted upper trend line of the descending triangle. The rise finished at the end of June with a V-top at the combination of the June 2014 high and 2022 low at 748. Turning lower throughout June, such that by the end of the month, prices were back down below the medium moving average and down this time at the purple highlighted extension to the lower trend line, the original descending triangle, currently 581, which I spoke about earlier, along with the important July 2021 low at 578 and the March 2021 low at 559. Since then, prices have moved sideways to a little lower, all the time making a new dark blue highlighted downtrend, currently at 586. It's quite shallow. This pattern construction is not a duplicate of what we have seen elsewhere in Chicago, for example, but it is a familiar one. You see, the V-top has also created an extension built from the action from late June to date. As I said in Chicago Week, I believe that one should not look at this extension in isolation, even though it has elements of a possible descending triangle or even a bear channel about it. Instead, look at it as part of the derivation of the V-top, a V-top with an extension. I think that is what late June to date's actions might be. So what can we tell from such a pattern? Well, usually such patterns are small and are pennants or bear flags, but not so in this case. However, it does not take away that much from the case for such a larger pattern. Thus, I would look for the dark blue downtrend and one of the following: the March 2021 low at 560, the March this year low at 551, or finally the newly drawn lower trend line for a bear channel, potential bear channel, currently at 542, to show the immediate support and resistance. The pressure in any such pattern would be for lower prices, and I can see immediately that below we have the important 38.2% absolute Fibonacci line at 533. However, personally, I would not even start considering I would even start considering down there the reconstructed December 1999 to date uptrend, currently at 496, and even perhaps the twin dangers of the 2003 to date uptrend, currently at 446, the 2002 to date uptrend, currently at 438 as well. I should stress these are not targets, Not yet. Just thoughts for another day. The only other feature I'd like to discuss is once again a potential. This time a potential for the possible bow tie formation we may recently have had. The short medium moving average currently at 599, the medium moving average currently 616, and the long moving average currently at 616 also. This again is not a possible but a potential, as I am really not happy about the way they crossed over, and so I'm not going to go and develop that any further for the moment. Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. Copyright is Eddie Tofpick and ADM Investor Service International Limited. And here comes the final important bit.